Hey, what's up, my friend? So, in this video, you'll learn how to trade the flag pattern. Specifically, you'll learn what is a flag pattern and how does it work. When is the best time to trade the flag pattern? Because not all flag pattern are created equal. And I want to share with you the two best times, right, that you should be looking for if you want to trade this pattern. And then, right, how to trade the flag pattern, a simple trading strategy that you can use to trade. So moving on, right, what is a flag pattern? So I define a flag pattern, right, using these two criteria. Number one, a strong trending move, right, usually shown by large bodied candles or large range candles on your chart, followed by a wick pullback, usually shown by small bodied candles. So here's an example. You can see over here, this is a strong trending move, followed by this wick pullback over here. So this one over here is what I consider a bullish flag pattern, right? Small bodied candles, right? It's a very weak pullback. This is also another example of a flag pattern, right? Small bodied candles, and you have this, strong trending move, just before this weak pullback occurs. Okay, so this is an example of a bullish flag pattern. Bearish flag is just the opposite, right? Strong trending move lower, a weak pullback, right? Something like this. Okay, so moving on, when is the best time to trade flag pattern? In my opinion, right, there are two times, right, which I find it favorable to be trading these patterns. Number one is when the market just break out. So for example, let's say the market is in a range, okay, and then it broke down. When it breaks down, right, the best time that you want to trade the flag pattern is on the first pullback. When you see a bearish flag pattern that is forming, right, this is the best time to trade the flag pattern, when the market just break out. Why is that? It's because number one, traders who miss the move, right, will be waiting for a pullback. So you can be sure that when the market pulls back, when this flag pattern is being formed, there are traders, right, looking to short this market, right, having missed the earlier move. So they're trying to, catch the trend, right? So this is why, I personally, right, like to trade the first pullback or the first flag pattern, right, when the market just break out. Alternatively, right, you can trade a flag pattern in a strong trending market. So in a strong trending market, you have, a trending move, then you have the pullback, trending move or pullback. So usually when the market is trending strongly, right, trading above the 20 period moving average, these are all possible opportunities to trade the pullback, right, in the form of a flag pattern. Okay, so I'll share with you a few examples, but let's talk about, how you can go about, trading the flag pattern. So first and foremost, right, let's talk about the long side of things, right? Let's say, for example, you want to go long on a bullish flag pattern. Number one, right, you can look to go long on the break above the highs. You can wait for a candle to close, or you can go long with a buy stop order. There's really no best approach, right? Whichever approach that you're more comfortable with, right, stick with it. Stop loss. I typically, set my stop loss 1 ATR below the low of the flag to give it some buffer so I don't get, stopped out prematurely. And the exit, right, you can use a moving average to trail your stop loss, or use structure of the market's higher highs, higher lows to trail your stop loss. For flag pattern, I would suggest that you try to ride the trend, because flag patterns typically occurs just after a breakout or in a strong trending market. So for me personally, I like to trail my stops to ride the move as much as possible when I trade the flag pattern. So this means that I don't have, fixed target profits or whatsoever. So just to share with you, a schematics to how it looks like. So let's say you have a market just break out. Let's say it breaks out from a flag pattern. You can go long on the break of the highs. Your stop loss, right? Let's say the market trade higher, break above the highs, you can go long. Your stop loss will be 1 ATR below this flag low. So from here to here, just 1 ATR. Let's say your stop loss is somewhere here, SL. Right here to here will be the distance is 1 ATR. Right, just pull out your average true range indicator, see what is the value, and then just minus the value, and you have your stop loss level over here. So let's say, for example, 1 ATR is, let's say, $10. And let's say this value here is somewhat, let's say, $200. So 200 minus $10, your stop loss will be at $190. Right, simple. And then your exits, right, you can either use a moving average to trail your stop loss, or as the market makes, higher highs and higher lows, you can just trail it using the previous low. So with that said, right, let's have a look at a few examples. So now this is the chart of crude oil, right? Sometime in 2014, 2015, you will notice that crude oil basically has been in a long-term range, right? For a good 1 or 2 years, right? The highs of about 118, 120, and the low of the range is somewhere around $105, $104. So you can see that the crude oil broke this area of support, and then it formed a potential flag pattern, right? Again, two ways you can look to enter this trade. You can place a sell stop order below this low, or you can wait for the market to break and close below this low, which it happened on this candle over here. So let's say your entry got triggered, you go short, right? Stop loss will be 1 ATR above this high. So let's say, I don't have the indicator right now, but let's say 1 ATR is somewhere here. So this will be your stop loss, SL, and this will be your entry. Trailing or stop loss, right? Again, I said that you can use moving average or structure of the markets, right, to anticipate that you could catch a potential trend. So let's say we use a moving average like the 50 period moving average, right? And you can see that in this case, right, you would pretty much ride the entire move towards the downside, right, and only exit sometime over here when the market breaks and close above the 50 period moving average. So a disclaimer, right, this is obviously a cherry pick examples. You won't regularly catch such a huge move, right? So this is more of a something that you shouldn't expect to occur regularly, right? But once in a while, you do catch, huge moves like this, right? So this is something that I want to point out. It's not a regular occurrence, so don't think that every trade will be something like this. Okay, so this is for crude oil. Alternatively, if you don't want to use the moving average, you can use structure of the markets where where you went short at here, right, trailing the previous high, previous high, previous high, previous high, previous high, and then this market actually basically breaks and close above this previous high. This is where you exit your trade. So again, different ways you can use to trail your stop loss. Another example. So this one is more of not a breakout example, but in a strong trending market. You can see that sugar is pretty much in a strong trending market, forming a series of lower highs and lower lows. So there is a few bearish flag pattern that you could have traded. You could have traded this, okay? You could have traded this, or even this. Again, the concept, the principle is the same, right? Go short on the break of the lows. Your stop loss will be 1 ATR above this high, so maybe somewhere here. For this, right? For this most recent example, right? Go short on the break of this low. Stop loss 1 ATR above this high, so let's say somewhere here, right? Stop loss, entry. Again, if you want to trail with your 50 period moving average, you can. Right, but in this case, right, you can see that the market pretty much break and close above the 50 period moving average, and this would have been a losing trade, right? Nothing wrong with the setup, right? It's a valid setup, but it just happens to be a losing trade. So one last example before we conclude today's lesson. Another one is a euro dollar. You can see that this market pretty much in the range over here. You break out of the range, right? Then you form this flag pattern over here. Could have gone long on the break of the highs. Stop loss 1 ATR below this low, say somewhere here. Even if you've missed this move, right, I'll say there were opportunities over here and over here. Okay? So how could you have, traded this market, right? You could have gone long on the break of the highs, right? Depending whether you enter here, here, or here. Like I've said, right? If the market just breaks out, the best flag pattern to trade is the first pullback, right? This would be the best pattern to trade. Of course, right? If you missed it, there's always opportunities that come later, but you'll be entering naturally at the higher prices. So let's say, for example, right, you didn't catch this move over here. You got in at the second one, which is this second flag pattern, right? This is your entry. Again, stop loss 1 ATR below this low. Again, just for the sake of completion, right, I'll just pull out the ATR indicator. Just pull out average true range, right? You can use 14 period. I typically use 20 period. Okay, then you just typically use SMA, click OK. So at this point, what you want to see is that what is the ATR, right? Right now the ATR value is about 80 pips, right? You can see, right, 0.008. So what you do is just calculate this low minus 80 pips, and that will be your stop loss. Okay, so how do you actually trail your stops? As I've said, right, you can use moving average. Let's use the 50 period moving average, and you can see that you would have ride this move until the market breaks and close below this low over here. Okay, so that is 3 examples for you. So let's do a quick recap. Number one, right? A flag pattern is a weak pullback of an existing trend, right? Usually shown in the form of small bodied candles. Number 2, the best time to trade a flag pattern is after a breakout or during a strong trending market. And to trade a flag pattern, you can enter when the market break above the highs with stop loss 1 ATR below the low. And if you want to, exit your winners, or maybe, it may be a winning or losing trade, but if you want to trail your stops, you can consider using moving average. In the example I shared with you, using 50 period moving average, or you can use the structure of the markets, right? If it's in an uptrend, right, you can trail it using the previous low to trail your stop loss. Okay? So with that said, right, if you want to learn more, go down to my website, tradingwithrayner.com. Right over here, I share with you, practical, actionable trading knowledge that you can use to improve your trading results. All right, I would highly recommend downloading these two trading guides: the Ultimate Trend Following Guide and the Ultimate Guide to Price Action Trading. This one will be the Trend Following Guide is to help you, ride big trends in the market and to learn everything there is to know about trend following. And the Ultimate Guide to Price Action Trading is about entries, exits, and know how to better read the price action of the markets. So just click this blue button, right, and I'll send it to your email inbox. Okay, so with that said, if you have any questions, feedback, just let me know below and I'll get back to you. So with that said, I wish you good luck and good trading. I'll